Welcome. Today we're going to talk about sales price versus appraised value. This is very important, and we got a lot of situations that we can go through, including things like a gift of equity that can kind of make that difference a little bit as well. And this is a question that comes up a lot, especially now in this current market where there are things that are appraising for sometimes more than what you're paying because other things are selling so quickly. It's bringing up the values, and how does that really affect you? That's what we're going to talk about in today's video. Please be sure to like and don't forget to subscribe. I really appreciate it. My name is Stephanie. I've been doing loans for 18 years, helping people with their financing. I've helped thousands of people. Whether you're moving in 9 days or 90 days, give us a call, shoot us a text, or send us an email so we can help you out. We're at weeksteam.com or 985-300-LOAN. Okay, back to the important part. Education. Home price versus sales price. What's the difference and how does it affect you? So I'm going to talk today about Fannie, Freddie, FHA, and RD, as well as VA actually. So it's kind of every one of those particular loan types. There might be some loan types out there that I'm unaware of that might view this a little differently, but I'm going to apply the guidelines of those when we're talking in today's video. So during the home buying process, you're going to encounter a lot of terms that you're like, what does that mean, right? You've got value, you've got appraisal, you've got sales price, and a million other ones that might throw you for a loop. A common question that comes up is, so I'm buying this house and I'm buying it for $200, but it's worth $250. Does that mean I don't have to put down payment? And so let's talk about where you're purchasing the property and the price is going to be $200, the value is going to be $250. Well, these programs that I mentioned state in their guidelines that the appraised value or sales price, whichever is less, is what determines the loan to value. Another one of those terms I'm throwing out at you, which means how much is your loan in relation to the value. And the lower is going to be used in those cases. So, and then the loan is going to have to be adjusted accordingly, like let's say if the price is higher than the actual appraised value. Now, another thing that comes up a lot in talking about these things is, why does the appraiser get a copy of the contract, and why does the sales price come in as the value so frequently? Well, that happens most of the time because directly from the appraiser's rule book, I've literally made them pull it out and let me read it. Well, now it's all online. I'm dating myself, but it says that the appraised value is the sales price as long as the price falls in the bracketed range of the comparables, basically because the home's worth what someone's willing to pay for it. So let's use our same house, a price of $200, potential appraised value of $250. The homes in the neighborhood have sold between $175 and $250. This house is being sold at $200. Technically, the appraisal should come in at the price of $200, even though it might come in at $250 if the price was $250, because that's what the buyer is willing to pay. Now, that's a little bit confusing, but just kind of simplifying that, that's very, very important for you to know. The equity is not yours until you own the property, and that's the reason. So even if it is worth $250 and appraises at $250 and your price is $200, your loan to value is based on whatever percentage of $200 that you're putting down or not putting down, because that $50,000 equity isn't yours until you actually own the property. All right, so the appraised value is decided by a licensed home appraiser. This professional will come to the house and evaluate the location, the home's condition, the features, and the improvements that have been made, and will factor all these things into account along with general market trends, okay? The appraiser is not chosen by me, the loan officer, and it's not chosen by the listing agent, and it's not chosen by the buyer's agent, and it's not chosen by the buyer. It is chosen based on going to a third party, a round robin assignment, and that's how the appraiser is then assigned. VA is a little different, but all the other loan types fall very specifically this way. That's done so that no one is enticing the appraiser to come in at a certain value versus another value. They want the lender, and you as the buyer should also want an independent opinion of the value. Now, another thing that comes up a lot is appraisers are human. And you might think this one house is most comparable and the other appraiser thinks the other house is most comparable, and either could be arguable. And there's gonna be a difference typically within 10% from appraiser to appraiser. So that could be different if for some reason you had two appraisals. It's rare, but sometimes it is required. And it wouldn't be surprising if there's up to a 10% difference between those two different appraisals. Now, the difference between the appraisal versus the sales price and why it matters, it has to do with your lending approval. Like we talked about, what is your loan in relation to your value? What is your down payment? It also matters because of your cash to close. Obviously, if you need more down payment, that's going to be more cash out of pocket, because your cash to close is going to be your down payment, if any, plus your closing cost, plus your prepaid items, plus any points that you pay for the interest rate buy down. That's going to be your cash to close. The other difference is on the property taxes. Let's use our same house. You buy it for $200, it's worth $250. The assessor assesses you at $250 and gives you high taxes on the property. Then you have the option to go in and say, here's my appraisal, which was $200. Here's my documents where I paid $200. Please don't tax me on the $250. I think you're wrong. Now, whether you win or lose, that's going to depend on the assessor and where you are and how their rules are. But that's going to affect the taxes, because we don't share the appraisal with anybody but our borrower. If you, the borrower, decide to share it with the real estate agents or the seller or the tax assessor, that's for you to share. But the assessor, for those taxes, they don't know the appraised value. They're going to see the sales price on the paperwork. The other thing is the equity in the home. Even if in our example, the lender is going to say you don't have, the extra $50,000 equity in the home, if you know that you do and you feel comfortable you're getting this deal, then you can always come back and refinance or pull cash out or get a line of credit. I'm not saying to do those things, but the equity will be yours as soon as you go to closing on the particular house. So the sales price is essentially the measure of how much the buyers are willing to pay and what they're agreeing to. And then the appraisal is when they come in and they say, hey, we think you're right, we think you're wrong, we think this is supported, or we don't. Now, I want to talk about a gift of equity next. I want to discuss a gift of equity because those can be done differently. So let's just use our same example, okay? Let's say that a family member is selling you the house for $200, and everyone knows the house is worth $250. If you buy it for $200 when it's worth $250, you might be bringing down the comparables of the neighborhood because you're buying it on paper for $50,000 less than it's worth. If they sell it to you for $200,000, then everything applies. If we do the sales price at $200,000, even though it's worth $250. What some people do in order to avoid extra money out of pocket is maybe that house might be sold for $250, which means it's going to be taxed at $250 on this at the assessor, which means that it needs to appraise at $250. So everything's going to be done as a sales price at $250, but a loan amount of $200, because $50,000 is a gift of equity from one family member to another in that example, which is only allowed for relatives. then the equity is yours from the get-go. The $50,000 does apply to the down payment, which is very different than what we spoke about a minute ago. We call that a non-arm's length transaction. I know you so close, you're within my arm's length, so non-arm's length transaction. That's one of the few exceptions where you can use that equity from the get-go, and you can base your loan to value based on the appraised value, which is going to be higher in this case than the sales price. I hope that makes sense. Please be sure to leave me some comments. I love chatting back and forth, and I definitely appreciate the support. Now, I do want to talk about what happens if the house appraises lower. And there might be some different laws in different states and different areas, and the parties can handle it differently. So I'm just going to give you some examples, but not necessarily all examples. All right, so let's say that you're paying $200,000 for the home. We thought it was worth $250,000. Actually, that happened just yesterday. The house was selling for $225,000. Thought it was worth $225,000. The house was actually worth $209,000. Okay. So in that instance, one, you can go back as the buyer to the seller and say, I want to renegotiate for the sales price. As the seller, you can go back to the buyer and say, okay, or I don't care. I'm still wanting $225,000, and if I don't get it from you, I'm going to get it from somebody, so you can feel free to walk away. Or they might say, I'll meet you in the middle. Or the buyer can do the same. I'll pay the $209,000, and we'll have to talk about that separately with the loan. I'll pay you I'll pay you the $225,000, or meet me in the middle between the $209,000 and the $225,000, or have you come down just like I mentioned in the first go round. So what some people do is they walk, some people meet in the middle, so on and so forth. Now, meet in the middle is only if you have money, because if you're doing 100% financing and you don't have extra cash to pay the difference in cash, they have to come down to the $209,000 for it to work for you. They don't have to, and they might not, but for it to work for you, it would need to be at the $209,000. Now, let's say that you were putting down 20%. Well, now that it came in less, then that LTV or loan to value is going to be affected, of course. So it is very difficult when houses do underappraise, because it does cause a lot of friction to figure out, where do we go from here? What do we do with this? Who's going to compromise in what way? Or is the deal just totally falling apart? Now, the other thing that I want to talk about as we're going to kind of wrap up here, and stay tuned, don't turn off the video because I'm saying wrap up, but the other thing is, remember I said the appraised value is the sales price as long as it falls within the bracketed range of the comparables, okay? As these homes are selling across the country and going above asking price, the second that those sales close, it's increasing the value of the other homes to then follow suit. So if you're under contract, let's say for $250,000, and you got lucky, you got under contract for $250,000, and before you close, or before your appraisal's done, and before you close, shall I say, other homes have sold and people are going $275,000 above. So instead of paying $250,000, like, I'll give you $275,000 on the house down the street because I want the house. Or somebody might offer $300,000, go $50,000 above. As soon as those other houses start selling, it's possible that your home that you're just about to pay $250,000 for could now be worth $350,000 if we've got other comparables that have sold recently in the area that would work as a comparable against your particular property. Because people were saying, like, well, man, there's no way these houses are going to appraise. And I'm like, well, as soon as 3 go and they're comparable, then the next one's appraising, the next one's appraising. So that's what's happening out there. So many of these deals, people are paying so much above asking price, and it's just driving up the value because, of course, supply versus demand. So I'm hoping that this video was helpful. I love and hope that all my videos are helpful to you. I appreciate you staying tuned. Check out my book, check out my course. Call me if I can help me, shoot me a message. Really appreciate the opportunity. Don't forget to share this with your friends and family as well. I hope you've enjoyed today's video, appraised value versus sales price.